This is a 25-point wide, and this is just the call side. So think about the spreads based on if you weren't going to receive any monies. Okay? You're not receiving any. So you're just doing a spread and they're not going to receive any money. This is the max loss. You calculate the max loss, and it's all based on how wide the spread is. So this is a 25-point wide spread. It's $100 per point. So you would take the $100 times the 25, and that would give you the $2,500. Okay? That would be your potential max loss before the credit you receive. So depending on how you adjust this up or down, it's going to decrease the max loss or increase the max loss. Okay? So, but it's also going to decrease the credit you receive or increase the credit you receive. So with this 25-point wide spread at this point at a 5 delta, you're right now getting 75 to $80. That's how much it's giving you, 75 to $80. But if you decided that you were going to change this and do a something like a 50-point wide, then you can see that it went from 80 to $115. So you're going to receive more, but in return, you're also going to have a bigger potential max loss because now the spread is 50 points wide. So if you don't calculate the premium that you receive, you can lose 5,000. That's your max loss if it shoots all the way up past this 42.30. The odds on that are 1% chance is going to happen at expiration, 2% chance is going to touch this 42.30 in the next 5 days. But to understand the spread, it's all about just your buying power, how it's going to affect your buying power, and that's associated with regulatory margin. That's associated with what your max loss is going to be on a spread. So it does not affect your probabilities at that point. It's all about your probabilities are based on deltas. This right here is all based on what type of credit you're going to receive and the buying power, and then in return how much you're receiving on that, right? How much return, what's your return on your capital? Because the 5,000 in this example is how much you have to put up for the most part, and then someone's going to give you $105, so that's how much you're going to receive on your return on capital based on how much you have to put up. So if you are, let's just say, Judy, that you are looking to do a spread like this, if you do the put side, then and if you keep the spread the same width as the call side or less, then it's not going to require any additional buying power. Okay? So when you leg into a position, you're legging in, you're assuming that, okay, well, I'm going to play this call side first because maybe the market is going down or maybe the market's going up, depending on how you determine what's happening. And so, but once you decide to play that opposite side, if you do not put on something wider, like for example, this is 50 points wide on the put side. If you put something on that's 60 points wide, then it's going to change this buying power. Let me show you how that looks here. So if I go over here and I'm just going to throw on something that's 60 points wide here, and so you can see that now the buying power has changed. Right? It's going to reflect that 60-point wide. So it reflects your max loss. So your max loss now is on this side. Right? Yeah, you can still lose 4,800 or whatever it was on the call side, but now you can lose 5,800 on this put side. So that's what it's going to hold into escrow that you have to put to the side. And as you adjust these strikes, once again, your credit's going to change and your max profit or your max you can win is going to change. All right. So is that
What about,
clear to this point, Judy?
yeah, what about when you want to, so I get it. So you're increasing your risk and
Mm-hmm.
but you're also increasing your premium. But
Mm-hmm.
now what about, let's say you do this deal right now and you're okay with 50 point wide, but what about when you want to get out of it? Would you just sell the short leg and let the long leg run? That would be the next
So
question.
so you want to get out of both of them at the same time, um, most of the time. I mean, that's ideal if you can get out of it at the same time. But if you get out of it one side, let's just say you get out of the call side only, well, it's still going to hold your buying power. It's still going to hold that premium because you haven't removed all the risk yet. But If you take off just the short legs, and the short legs are the red legs, then it will, if it's say the red leg on the put side as well, if you take off those, then it's going to reduce your risk, right? Because then you don't have any risk anymore, because the long legs is not your risk in this type of trade. Okay? Um, but it's gonna cost the wider your spread, it's gonna cost a decent amount to get your um, to buy back your puts at certain, depending on the time of the day. So usually, what will happen, Judy and everyone else on this call, it's usually going to be one side of an iron condor with these short-term trades that's going to basically be worthless, and it might be hard to take off the the long leg here. Right? It might be hard to take off that long leg, and let me explain that from the zero DTE trade at this point. And so, yeah, you would just buy back a short leg, Judy. So, for example purposes, right now this put side has all these zero bids here, all these zero bids. Well, that's because no one's going to buy this from you anymore. It's about 40 minutes left in the trading session, and these all these options are going to be gone. They're going to be expired, right? So no one wants to buy these anymore from you. So if you have a position on that's an iron condor and one of your legs is like this, then it could be hard to get out of the trade because of that. So what you do then is you just buy back your short leg. So it'll look something like this. Even if it looked like this, right? Even if it was like this, both legs have this zero bid, right? But you're not going to be able to get out of this one, right? Because that's your long leg. You have to sell it. You have to sell it to get out of it. But you will always be able to get out of this one because someone is always going to sell you something, right? So if I think I'm going to get zero for something because it's going to expire in the next 30 40 minutes, and then you come around and say I'll buy it for you for $5, then you're going to be like sold to the highest bidder, right? You're going to get rid of that position. So you can always get out of something that you're buying. Just to make it clear, you can always get out of something you're buying. You can't always get out of something that you are selling, and it happens a lot more with short-term trades, like something that is zero or one DT and so forth. Can it happen to something that's a little longer than that? Yeah, but it's rare. It's rare that you can't get out at that point, right? Because it still has time, so it's still going to be worth something, right? Someone would still buy it at a certain price when it's still a decent amount of time to go. So hopefully that answers your question, Judy. But I just want to make sure that you understand, you do that. If I'm going to do a 10-point widespread, my max loss is only going to be 1,000 before I receive. If I'm going to do a 15, it's going to be 1,500 before I receive the credit, and so forth. But you're increasing your max potential loss, which you shouldn't have on a short trade if you're trading it correctly. The only thing that could change when you do a spread that's higher is your probabilities, right? But the max loss and all of that kind of stuff will change because you're receiving more of a credit if you go on a higher delta. So for example purposes, if I had this five delta here and I did the 50-point wide again that we were looking at, right? Well, the max loss on this is 49.10, right? 49.10, because I'm only receiving $90. But if I went up and I started this trade, let's say at this 16 delta, for example purpose, and I did a 50-point wide, then you can see now I'm collecting more, so my max loss is about $300 less. Okay, it's about $300 less because I'm collecting about $300 more. So just by going from a 5 to a 15 delta here, but keeping the width of the spread the same as the same as 50. So, keep that in